Hi, good evening, everyone. On behalf of the Penn Club UK and the Wharton Club UK, thank you for joining our webinar this evening on tax and investment strategies for U.S. citizens living abroad. My name is Michelle DeMonico Oppenheimer, and this is a topic particularly interesting to me as I recently relocated just over a year ago from New York to London. And I was surprised to learn that, among other things, the UK has a completely different calendar than the US, and they're need to wade through. So I wish I had had this webinar back then. But without further ado, I'd like to turn over the presentation to Jonathan Gold and Tahir Mahmood from London and Capital. Go ahead, Jonathan.
Thank you, Michelle. And thank you also to Ashley for inviting us to speak today. Thank you to the Penn Club of the UK and the Wharton Club of the UK for allowing us to speak to you and to your members and your alumni. So today's presentation, we're going to look at some of the main tax issues that face Americans living in the UK. We'll also look at some of the ways that you can plan your investments and the difficulties that arise being an American living in the UK that people have in terms of organizing their financial assets and some solutions for how to overcome this. Our presentation today should last about 40 minutes. We'd invite you to ask questions as we go along. On the bottom right, I believe, of your screens, you should see a Q&A box. Please feel free to add questions as we go along, and if we can, we'll address them in line with the presentation or maybe address them at the end if we need to. So who will you hear from today? So today's presenters include myself. I'm a director of the US Family Office at London and Capital. My role is to help clients organize their finances, to create an effective investment strategy, and to manage their investments in a tax-efficient way. I work alongside my colleagues on our investment desk and also with my tax-qualified colleagues, including Tahir Mahmood, who will introduce himself.
Thanks, Jonathan, and good afternoon, Penn and Wharton Club. By way of introduction, I trained as a UK and US tax advisor with Franca and PwC. I then joined London and Capital 6 years ago to overhaul the tax reporting. From there, it has progressed more into a tax structuring role. So now I look at onboarding clients and see how we can restructure and optimize so their affairs fit in with the IRS and HMRC rules.
Thanks, Tahir. Your sound's maybe a little bit quiet. I don't know if you can just look into that, perhaps. So what will we cover today? I will briefly introduce London and Capital, outlining the services that we provide specifically for international Americans. Tahir will then cover the headline tax issues for Americans living in the UK, and he'll cover areas including employment, property tax, some estate planning areas, US and UK investments, as well as pensions. Now, a disclaimer, we are not tax advisors and we don't do compliance or tax return filing. But as you'll see throughout this, everything that we do for our American clients is tax aware and incorporates the tax planning into our investment strategies. We've got 3 members on our team who are tax qualified in the US and the UK, and they focus on these tax-related issues really to ensure that our clients maximize their after-tax returns. I'll then follow Tahir and present on how Americans can organize their investments and create a tax-compliant global investment strategy. So the US Family Office at London Capital, what do? Well, we're an investment management business at our heart. We look after over $4 billion on behalf of our clients, predominantly private clients. We've been looking after clients since 1986, and we've been advising US clients since 1989. The offering really is split into 3 parts. The investment management is just a part of it. Firstly, it's about setting a strategy, creating a risk profile for clients, helping clients organize their global assets, which really falls into the strategic wealth planning. And those assets can be held in the US, in the UK, or actually anywhere in the globe. The second part of the offering is investment management. And as I've outlined already, and you'll see, it's about tax-efficient investment management. And that's not just talking about a single pool of capital and how you think about the investment returns and the tax implications of that, but it's organising the tax efficiency across all strategies. And then the final part of what we offer, we term consolidated reporting. And that really falls into two camps. The first part is reporting, obviously, on the portfolios that we manage, both online and offline. But it's also about providing the information to enable US clients and UK citizens and UK residents to file their tax returns. So providing the information that you can give to your CPA or your accountant and easily file your 1040 or your UK tax returns. Today's talk will go into more details about how to think about your tax and how this envelops into your investment strategy. Now I'll pass to Tahir, who will talk you through some of the headlines on taxes.
Thanks, Jonathan. Does this sound a little better now?
Yes, perfect.
Okay. So I'm going to run through a case study today, but I thought it would be good to give a quick overview of the basics of US and UK tax. Hopefully you can see everything that's on the slides. US tax. I'm presenting to the Penn Wharton Clubs, so I'm going to make an assumption that you're all fairly well versed in US tax. So we'll keep this just to a very high level for now. It's done on a self-assessment basis. Worldwide income and gains of US persons are taxable. This is the big differentiator for the US, and there are only a handful of countries which will have worldwide taxation on their citizens. This means that if a citizen moved to the UK 20 years ago, they still have a US passport, they will still be taxed on their worldwide income. You also have individual state taxation. Depending on where you live, you may have an income or a filing requirement in that state. There's a few exemptions, such as Florida and Texas. Then you've got the big states like California and New York, where you will have tax liability. Flicking over to the UK. So there's two key terms we need to understand before proceeding with the UK tax. First one being residence. This is very clear and based on specific factors and day count. For example, if you spend 183 days in the UK, you may be considered UK resident and therefore taxable here. Domicile, this is the second term. I think of it, although the best way to really think of this is where you belong. So there are four main types: origin, dependency, choice, and now we have a new one called deemed domicile. As a general example, if we had an individual who was born in the US, but then moved to the UK, typically we'd still expect them to be domiciled in the US, as this is their home, but on an ongoing basis, they're living in the UK, so be a resident in the UK. This client would be considered a non-domiciled individual. So, as a UK non-dom, HMRC have given individuals two ways which they can be taxed: the remittance basis and the arising basis. The arising basis just means you are fully taxed in the UK on your worldwide income. The remittance basis, this gives individuals the ability to be charged on their UK sites as assets and anything brought into the UK. This can be beneficial if you have significant assets offshore. The downside is that once you've been in the UK for 7 years, there is a £30,000 charge. So what are the main issues as an American living in the UK? I'm going to come back to a lot of these points listed in front of us in a bit more detail, but just as a high level. So the confusion as to what you can invest into. You have PFICs, US funds, pensions, ISAs and trusts. PFICs are probably a term that you're all very familiar with. Essentially, it is any investment that the IRS cannot see into directly. For example, a UK resident who invests into a UK fund. The IRS don't have full oversight of what this is, so they tax it at ordinary income rates and then charge interest and penalty on a very punitive basis. But the one saving grace is they limit the penalties, interest and charges to 100% of the tax. Second one being two different tax regimes and reporting requirements. Michelle's briefly gone over this, but we've got the UK tax year, which makes no sense and runs from April to April, and the US, which is calendar year. We have tax optimization. There's different rules.
Tahir, sorry, someone's just said they're having a little bit of trouble hearing you. So I'm just wondering if you could maybe just speak a little bit louder. Sorry.
Okay, I'll speak a little louder. Is that clearer?
Yeah,
So
I can hear.
You can hear. Tax optimization. This is quite a large area due to the overlapping rules. For example, short versus long-term tax, differing tax rates, and differing treatment of tax wrappers. Each jurisdiction has its own tax-exempt structures. For example, in the US, you have muni bonds. They're tax-exempt, but it can give you a lower rate of return due to this. But as a UK resident, these will be fully taxable up to 45%, therefore wiping out any potential profits. Currency. This is such an important area due to the swings in the FX rate we've seen in the last few years, especially when looking at tax planning. Both the IRS and HMRC look at spot rates at the date of purchase and again at the date of sale. This means you could crystallise a USD loss in December to set against any gains that you've made in the year. But when you FX this back to pounds, it turns out to be a large gain. Trusts. This is quite a complicated area, and I don't really plan on delving into this today, but you've got mine and Jonathan's contact details. Drop us an email afterwards and we can go through this. And the last one is credit and mortgages. I'll go through this in more detail on the case study. Just before we start with the case study, I thought a visual representation of the tax years would help. So the US follows a simple calendar year, the orange line above, and the UK, the fiscal one, so the blue turquoise line underneath. At first looks, it doesn't appear that cumbersome, but the problem comes when you have to report this income. And I hate to say this, but the IRS very sensibly issues 1099s after the end of the year, and then you file your taxes by April the 15th. And the 1099 is in dollars, calendar year, plonks straight onto the 1040, and it's nice and easy. The issue comes when you're a UK resident, is when you have to file your UK tax return. You have the investment income for your 1099, which is in dollars. Gains and losses are calculated on a FIFO basis, and then this needs to be prorated over the tax year, and you may have a mismatch of foreign tax credits. Case study. So the easiest way to illustrate the tax points is to give an example situation. But please note these numbers are illustrated just to give you a feel of how the tax works. So we have Chris, a US citizen, moved to the UK in 2010 and married Sam, British citizen, and they now have 2 children. Chris earns $300,000 per annum and Sam earns $450,000. They purchased a property in 2012 at a cost of $2 million, and it is now valued at $3.8 million. Estate planning, they haven't done any. US investments, they have a joint investment portfolio worth $1 million based in the US, invested in mutual funds. They all have UK ISAs invested in a variety of reporting funds, UK reporting funds. And lastly, Chris has an IRA worth $650,000, and Sam has a SIP worth £800,000. So let's look at the employment first. Sam's situation is relatively straightforward. Being UK resident, she will be fully taxable on her UK income and not have a liability elsewhere. Chris is the one with the more complex situation. He's been resident in the UK for 11 years. This means he has passed the 7-year mark and has the option to be taxed on a remittance basis, but this will cost him that £30,000 charge that I mentioned before. Also, as he is a US citizen, the IRS still have the right to tax his income. Fortunately, we have a tax treaty and double tax is alleviated by a foreign tax credit system. So if we look at the numbers, the UK tax liability on the $300,000 is approximately £120,000. Chris will pay this amount across the HMRC by his normal monthly withholding as an employee, and we call that PAYE, pay as you earn. At the end of the year, you're still going to have the US filing requirement, so the £300,000, equivalent dollar number, needs to go on the US tax return. This will flow through and calculate a liability of around $130,000. As he has paid tax in the UK of $120,000, this will sit as a foreign tax credit on the US tax return and it'll be taken against the US tax paid. Fortunately, most of the time, the top rate of tax in the UK is higher, which that's a fortunate thing, but 45% versus 37% in the US. So the UK taxes will wipe out any US taxes paid. Property. They purchased a property in 2012 at a cost of $2 million and it is now valued at $3.8 million. From a joint perspective, there are no issues for holding UK property. The issues only arise on sale. So for this case, I'm going to assume they are looking to put the property on the market and want to understand the tax implications. When selling a property, there are two separate parts to look at. One is the gain on the house, and the second is the gain on the mortgage. Firstly, let's look at the pure gain on the left-hand side, titled sale calculation. The property is owned at 50-50. Sam's half is exempt, so I'm going to focus on Chris's half. Running down the pounds column, we have a cost of £1 million, sale proceeds of £1.9 million, which gives us a gain of £900,000. Being the main property, this is exempt from UK tax. It's under a scheme called Principal Primary Residence Relief. Now the USD column. We have the cost price. These, both cost and sale proceeds, these need to be FX'd at their respective dates into dollars. So we have $1.8 million as the cost and $2.47 million as the sale proceeds. The IRS gives American citizens an exclusion of $250,000 per person. There's a couple of rules around that, but I'll assume that they get this full exclusion. And this brings the gain down to $420,000, which would be caught by long-term capital gains tax. So that's the first part of the calculation. To complicate things even further, we have a phantom gain calculation. So if you look over on the right-hand side, we have originally they took a mortgage of £800,000. The IRS will look at the dollar equivalent of this when it was originally taken out, which is just over $1.4 million. And then they'll look again at the dollar when this was paid off. So the FX rate has changed from 1.8 to 1.3 over the period, which means they're paying off a much smaller liability, and the IRS will see this as a $660,000 gain. Onto their investments. They have a joint investment portfolio worth $1 million based in the US, invested in US mutual funds. The US tax implications for Chris first. Being the American, Chris will be taxable by the US on his worldwide assets. Funds are US, so we tax on their constituent parts. That will be the dividends, capital gains, and interest. The UK tax implications for Chris and Sam. The UK is a little trickier. HMRC has its own set of rules similar to the IRS's taxation of PFIGs. HMRC say that any asset they do not have full reporting on will be taxed as an offshore fund. So when it is sold, the gain will be taxable at 45%, so the top rate of income tax, both of them. Are there any currency implications? There are no issues on the US side because it's a dollar fund, dollar reporting, nice and simple. But on the UK side, everything needs to be valued at purchase in dollars and again on sale in dollars. That means if the dollar has strengthened against the pound, an asset which has stayed flat in the US could give rise to a large taxable gain in the UK. Now onto the UK investments. So an ISA is an individual savings account. Individuals have the ability to contribute up to £20,000 a year into these, and they are tax-free from a UK perspective, which is great tax planning. Sam has no US links, so there's no issues for her. Chris, being the American, is our problem again. so that the IRS don't recognise the ISA wrapper and they look straight through the investment and then we tax on a rising basis. So to compound this even further, Chris has invested the ISA in PFICs. These are the assets the IRS do not like. So instead of paying 0% tax like Sam, he is now liable to 37% on the income with potentially tax-free wrapper, and then with even more penalties on top. Okay, lastly, I will look at estate tax. Current lifetime allowance in the US is 11.58 million. This was due to sunset in January 2026 down to 5.49 million. This is one of the rules that Trump has in place. This is per individuals, so couples get just over 23 million. But in our situation, Chris is the American and Sam isn't eligible to the 11.582. So what are the Biden changes? Biden spoke about reducing the 11.58 down to 3.5 million. This is still not confirmed, but if it comes in the next few years, it gives Americans a window of opportunity to maximise their 11.58. Can Chris give to Sam, and how does the $157,000 work? As we have a mixed marriage here, if Chris gives to Sam, they see it as a flight, they being the IRS, see it as a flight of assets out of the US. This means they limit the annual gift allowance to a non-American spouse to $159,000. Any amount above this will claw into lifetime allowance of $11.58 million. What happens at death? So without wills and estate planning, the IRS deem everything to be sold on the date of death and value this against the remaining lifetime allowance, and any excess amounts are charged at 40% to the estate tax. UK rules. So the headline number in the UK is 325,000, which I'm sure you've all seen compared to the 11 million. Anything outstanding above the 325,000 is subject to UK estate at 40%. Fortunately, Chris and Sam have the ability to give an unlimited amount to each other as a married couple. Also, outside of the marital exemption, there is something called a potentially exempt transfer. This gives individuals the ability to give unlimited gifts in their lifetime to whoever they want, but there are several rules around this. But the main one being you have to survive for 7 years after the gift for it to be considered completed, and you must not benefit. So they can't gift their house away to their children to try and get it out of their estate. I think that is everything. Jonathan, back to you.
So just before I move on to talk about some of the investment or the investment planning side of things to here, actually, there's a couple of questions that have come up on some of the tax-related side, and perhaps just worth addressing those now, if you don't mind. So one of the questions that we've had was, you'd mentioned the 183-day limit. And do you know if HMRC are being flexible with this due to COVID?
Yes, they are being flexible with it. If you've been caught in the UK due to the COVID rules, there is flexibility around it. But the 183 rule is a very high level number depending on your ties to the UK. There's something called the statutory residence test. They look at whether you've got family, property in the UK, and you can potentially cut down the numbers to 45. But worth speaking to us directly, we can go through the specifics on the residency test.
Thank you. There was another question around ISAs. You gave an example there that suggested that it's not tax efficient for an American to own an ISA. Are there any ways that there may be tax efficient ways for them to do so? Of
course. So with an ISA, we looked at the tax rate earlier, the 45% top rate in the UK compared to the 37% in the US. Those numbers are key. What we would do with an ISA is invest it into direct stocks and bonds. Then you wouldn't have the PFIC issue. It'd be exempt from UK tax. The US would still get their chunk of the pie, but they would do it at a lower rate than the UK would charge. So it's all about the differential Ordinarily, the UK would charge 38.1% on a UK dividend. If it was in an ISA, it'd be caught by the 20% US tax. So there's a marginal saving. It definitely makes sense to put into an ISA and structure it correctly within. Just be very careful with the PFIX.
Thanks, Tahir. There's quite a few questions. I think we'll save some of them till the end, but there was just one or two that maybe just for clarification purposes. I know that I'm going to probably use the same terminology. Someone asked, what is a PFIC? If you could just clarify what a PFIC is.
Sure. Sorry. A PFIC it's a passive foreign investment company. It wrapped up investment outside of the state. So any fund that you've got in UK, France, anywhere outside of the US, it's wrapped up. The IRS can't see directly into it, and they say, we're going to tax you at the worst potential rates.
Thanks, Tahir. I'm sure everyone, there's lots of questions, and I promise you we'll go through all the questions and we'll address them all. But and people, I'm sure, would be happy to listen to people talk about tax all day, but sorry to disappoint everyone. We're going to move on to the much more interesting subject of investments, or maybe not. But this will just tie together all the stuff that Tahir's talked about, how we think about this from a planning perspective. So just switching into investing for US citizens, as Tahir's really outlined, there is a lot of complexity. I think the issues for the mismatch of the years, the way that different investments are taxed, the complications of having assets in jurisdictions. This can provide US clients with real headaches in trying to implement this into their investment strategy. This just represents some of the issues that our American clients can face. So the administration really and actually it could be any client, of what you have and where you have it. That in itself can be an administrative burden. Then you have the near impossibility really for establishing a coordinated plan. When you've got assets in different jurisdictions managed by different managers with different risk profiles, that can create all sorts of difficult problems. And having two accounts in different organizations with different relationship teams, with different online or offline reporting, that can be a problem. And often even in the big institutions, the big global or big US financial institutions, it's not uncommon that you'd have to have two completely separate relationships just to try to manage that. Obviously, from a risk management perspective, there's all sorts of risks. I've just named a few. So diversification risk, which can be whether you've got too much or too little held in certain investments. Where accounts aren't managed together, it's obviously impossible to tell independent managers what they should or shouldn't be doing. Tahir spent a long time on the tax side of things, and the difference between the different tax reporting years, mismatching of tax credits, the inefficiency, as I mentioned there, of PFICs or offshore income gains, which is the UK's sort of equivalent of the PFIC rules, can be very difficult. We've touched on reporting, and we'll talk a little bit about how clients can maybe come up with a strategy for improving their reporting. And the final point really deals with, well, relationships where there's perhaps one more financially sophisticated party than the other. And it's not uncommon that this is the case. And where we see this really being probably the most difficult is obviously at the time of a state someone passing away, and having that less financially sophisticated party not knowing where anything is can obviously cause extra anxiety and stress. So what would be a way that somebody might organize? Well, from a very top line basis, just looking at really the structures or what someone might own. As you can see there, the US has assets that we would call toxic or really tax inefficient. And as Tahir has outlined, really, you want to avoid non-US funds. So from a US perspective, you don't want to own those PFICs, so those passive foreign investment companies, because they're taxed at top rate of income tax, and there's all sorts of penalties attached to them. From a UK perspective, we have a very similar set of rules. And so all those US qualifying mutual funds, the UK doesn't recognise those, and you've got all of the implications that Tahir's mentioned around foreign exchange gains, regardless of investment gains that may exist. So really, just from a very, very simple perspective, qualifying, compliant, organized assets typically involves global equities, global fixed income, single line securities. There are some ETFs that may be appropriate because they have this dual reporting status. But broadly speaking, if you think about organizing yourself with individual securities, then you're not going to go too far wrong. So what can you do to organize yourself? Well, first of all, you need to know what you have. So this is representing a range of investment structures. And for those of you who are looking at this page, I'm sure some of the terms and some of the different structures will be familiar to you. But really, this is just representing the range of complexity, I suppose, that an individual may have with their investments. When you start to add in a partner or a spouse, family investments, then you can multiply the number of these accounts that somebody may own. And obviously, as Tahir's pointed out, if one of the partners is American and the other is a non-American, then you may have all of these conflicting rules held amongst the familial structure. So that may just add even more complication to it. So just to color this in, let me show you an example. And this is an example of a client who may come to us, as we say, before they're organized. In this case, it's a married couple and they've got a couple of children. Really, the point is, when you look at the number of different accounts, what they are facing are US accounts and UK accounts. They've got currency reporting in dollars and sterling. They've got accounts in different jurisdictions. And as you'll see really at the bottom in this case, this situation, they had 19 different accounts holding different amounts of money with different currencies in them. But more really alarmingly, I suppose, for them is they have 12 different investment managers managing 12 different risk profiles. And that really is the complexity, both of the clients knowing what they have and where they have it, but really the organization and the reporting and really the complications for thinking about how this can be managed in a tax efficient way. So what can you do about it? Well, one way is to consolidate some of the assets. So merely shifting some of the accounts where you have perhaps the same tax basis, the same reporting currency, and consolidating those investments into a single strategy. Obviously, this is very hard to do if you don't know what you have or where you have it. But if you do, and you've got a way of organizing this, then working with a partner that can think about managing those assets on a global custodian platform, reporting in a consolidated way can help you get organized. So the first thing, think about a global custodian that can manage all of the assets in a single place. Once you've started to do this, this can then lend itself to simplification of your accounts. And what that will allow is the coordination of the investment, coordination of the investment strategy, and that allows for a management in terms both not only of risk, but also some of the tax and the tax management that Tahir has outlined that you could do. And obviously the final part of this, it can simplify your reporting. So holding your assets with a custodian or an investment firm that can manage and report on your global assets can actually provide a lot of simplification across all of the investments. Now, in this case, what you'll see, and just to remind you what the account was beforehand, this case had 19 different pots of money with 12 different strategies. And in this case, we've been able to consolidate it, down to 10 accounts. But managing those accounts across one investment management firm can obviously provide a huge amount of simplification and coordination across those assets. You'll see at the bottom it says there's 2 risk profiles, and the reason there are 2 risk profiles is really just a simple case of having one for the parents who may have a different strategy to the children and a different risk profile for the children. So how might you simplify this? Well, this is what it might look like. So in terms of a consolidated risk profile, as I've mentioned earlier, this is all about organization. By having the accounts organized, This enables implementation of a unified plan and a consolidated risk profile. So this chart showing you how a client can set this coordinated investment plan across all of their accounts. The pie chart really just represents the overall asset allocation or the risk that may be managed for this portfolio. So for the parents, this is their risk profile. And on the right-hand side, what you can see are the accounts that are being consolidated, the currencies in which they're being managed to, or the reference currencies, and the structure there, or the IRA, or the ISA, or the joint personal accounts, really reflects the tax position or the tax situation of the structure in which the accounts are held. Now, if you're, just to flip back, if you're holding, all of these different portfolios with different managers and different risk profiles, then that's an impossible thing to do. So creating a simplification is a way of organizing your assets, but creating it and managing it in a tax-efficient way. So we can then take the tax efficiency a stage further. Now, I imagine people are looking at this going, I can't read what it says on the chart, but it's sort of there in a way that you can't read what it says, almost for a reason. And the reason really is we're not here to try and represent particular investments or securities, or today is more about the tax side of things, the organization of things, and creating tax-efficient investment strategies. So what this chart represents, and the table on the left-hand side, you can see at the top, it represents the total assets of the family that we were talking about before. And that's represented by the number at the top. And at the bottom, you can see a representation of the risk profile. So in other words, in a consolidated way, how those assets are being managed. Now, the bottom represents a sum total of the assets that are being managed within each part of the portfolio, but the lines across the middle are talking about the different taxable structures. So Tahir, we call this optimization. Perhaps from your perspective, maybe just talk a little bit about how we are optimizing the investments in some of the different taxable or non-taxable structures.
Of course. So you said in your slide there, rather than equally weight the asset allocation to each portfolio, the assets are optimized across the separate portfolios. So how does this work in practice? We put the interest-paying investments that are taxed at 45%, such as the fixed income, into the non-taxable account, like the IRA. And then the growth assets, such as equities, would go into the brokerage account. The equities pay dividends, which are taxed at 20% in the US, and capital gains on sale, which is also 20%. So by rejigging the assets into certain pots and running it like this, you'd still have 3% cash, 30% bonds, 67% in equities, but this could increase your performance by up to 25% every year, which is then compounded again by the life of the portfolio. It's probably a good point for me to go to the next slide, and I will jump over to that. So tax-efficient account structuring. Once the accounts have been structured, as Jonathan highlighted previously, there's another level that we need to look into. Separate pots need to be segregated into their constituent parts. This means the clean portion, clean capital, income in the middle, and mixed gains to the right. You do this to keep everything separate. By segregating out to the assets, you can pick and choose which funds you spend in each location to avoid any double tax. It's quite a niche area, but it is very important for res non-doms. So if you've got any questions, please contact us separately on this issue.
Thanks, Tahir.
Lastly, one last slide. We have the tax reporting, probably the bane of everybody's life at the moment. So on the left side, we have, these are example reports that we send. We have the US tax report on the left, based in dollars, calendar year. It's probably a little bit small to read, but essentially we break down the income produced on the account into three areas: capital gains, short and long term, dividends, and interest. The report mirrors a 1099, so the numbers can be put straight onto the 1040. On the right-hand side, we have the UK report, fiscal year in pounds. Majority of it is similar to the US, But an important point is that all sales have been foreign exchange at the date of purchase and again at the date of sale to produce the correct gains in pounds. So it's a pound report on the fiscal year. The one thing that I haven't included in this is the FR reporting. So it's the separate sheets we include. But as Americans, you have to file a FinCEN 114 or the FR showing the maximum value of your accounts at any point during the year. So we produce this as a separate report that shows the correct account details and the address, all the numbers that need to go onto the FR. Back to you, Jonathan.
Thanks, Tahir. So really, this is just a question of really summarising and wrapping up the things that we've talked about. I think the main point, hopefully, that I'm sure most people who are watching will know that as an American in the UK, it's difficult to plan from a tax perspective and then multiply that by a huge number when you try to think about investing from a US and UK perspective. I think the key message really is have a coordinated plan that works across your global assets, that thinks about the currency exchange and the currency management. Avoid funds. I think that's basically a headline rule in summary, although we'll come back. I think some of the questions are asking about funds in certain structures, and we'll come back to that. You can own an ISA, but again, don't own any funds in there. Use your allowances and make sure you use your tax credits and offset your tax credits and align them. And I said right at the start, we're not tax advisors. And if you don't have a US and UK tax advisor, then I would highly recommend that you get one who can help think about the issues from both jurisdictions. And finally, from our perspective, make sure that you have the correct reporting information. Obviously, there are lots of organizations who will take on clients and say that they can manage money for American clients by possibly avoiding PFICs or funds, but that doesn't really scratch the surface for what you need to avoid, obviously, short-term gains or report in the correct way. So that's the end of our formal presentation. We've got a lot of questions to go through, and happy to just try and pick those up and either Tahir or I will answer them. So they're not in any specific order. I'm just going to ask these questions as they arise. Tahir, there's a bit of background noise I can hear there, but just the first question is around pensions. Is there a preferred order of drawdown where one has both a 401k and a SIP? Probably covers both the tax and the investment side of things. Tahir, I don't know if you've got anything you'd like to comment on that.
Yeah, I was getting a little bit of feedback from my microphone, apologies. Yes, there's definitely a preferred method of drawdown. The 401k potentially can turn into an IRA, and then there are specific rules. So there's R&D rules, and you're forced to take certain portions out of your US pension. But the biggest reason, and the reason I would keep in the SIP, is it is exempt from UK estate tax. So a lot of it does depend on your individual situation, but there will be a more beneficial way to draw these down, and probably worth reviewing the individual situation.
Okay, thank you. The slides will be made available after this presentation. So for the person who asked if they will be, then I believe they will be. And Michelle, hopefully, if that hasn't been organised, that can be arranged afterwards. I have a specific question here from somebody asking, as an independent contractor to a US-based company, but they've relocated to the UK at the end of 2019 and paid in dollars. They're now resident in the UK, but domiciled in the United States. How should this be set up with HMRC? I guess quite a specific point there, but a UK resident, US domicile, having moved here in 2019.
So there's a few things that we need to consider here, Jonathan. One would be the GILTI provisions, holding back any of the company's profits, or it's a US-based company. So it may be pulled into UK tax. There will be UK tax on the income as well. I'd need to actually fully review the situation, but I will double check and come back on this one.
Okay. What somebody has asked, would you advise the non-US citizen to purchase / keep the house in their name only? I mean, generally speaking, obviously, depending on your financial arrangements with your the person you're buying the house with, then if US people don't buy the house, then clearly that can alleviate and get rid of any of those tax implications from the US arising basis. And as Tahir mentioned, the UK has no tax charge for your primary residence. If it was a secondary residence, Tahir, maybe you just to very briefly touch on the implications for that.
So if it was a secondary residence, the UK actually does charge on capital gains, so they charge an even worse rate than normal, so it's 28% in the UK. So it probably would make more sense actually to put the secondary property in the American's name. They're going to have to pay UK and US tax anyway, but the primary property always in the UK person's name. Keep it out of US tax completely.
Thanks, Tahir. Okay, the next question is the £30,000. So this is referring to the remittance basis charge that you referred to here. So is the £30,000 to keep offshore income offshore from a UK perspective a tax credit for IRS purposes?
Simple answer is yes. The £30,000 is just a charge against your foreign income, and you can take it as a foreign tax credit on your US tax return.
Okay, what spot rates do you use to convert your UK income on US tax forms? Okay, I think you touched on that during your presentation to here. Just to recap.
Yeah, the spot rates are, it depends what type of income. If it's employment income, it would be an average exchange rate. If it's purchase of an asset and the sale of an asset, we use the Bloomberg USD to pound exchange rate on the spot. So for purchase and sale, completely separate. But
thank you.
Also, there's a few others and some slight complications to that when you're doing FBAR reporting. So they have treasury rates, but most of the time it is spot rate on investments.
The question here that I will take, are there US limitations in dollar amounts for annual contributions to UK workplace pensions? There's not dollar amount limitations, but there are lots of rules on UK pensions in terms of contributions that can be made. Actually, the rules are there are unlimited amounts that can be made, but the tax efficient and tax free amounts that you can make are limited based around the amount of income that you earn. The simplest, you can contribute up to £40,000 tax free, and that's based around people who are earning less than £150,000. But once you start earning above that, then the amount that you can contribute tax-free ratchets down, and actually it tapers off. So if you are a higher rate earner, and in Tahir's example, those two would be deemed to be only allowed to contribute up to £4,000 a year from a tax efficient basis. But clearly, if it's a workplace pension and your contributor is contributing, then you want to think about the fact that they may be giving you free money. So that's probably another conversation, and maybe one just to pick up offline if that person has some specific questions. The shadow gain example on the house. It was a question around explaining the shadow gain there on the house. I know you talked about that. It is a complicated area to hear. Maybe just briefly, just recap on how that example works, just in a simple way. Thanks.
I won't go back to the slides, but what the IRS do is on the purchase of your house, you take out a mortgage. They say the mortgage will be converted at that point into dollars, and they'll say you've got a dollar debt at this point. When you go to pay down the mortgage, the say 20 years later, there's a small balance left. You pay that mortgage down. The IRS will then FX that number and say, you've only paid down a smaller amount, therefore the difference between the two, that they take away your regular contributions, so ignore the monthly capital repayments that you get. It's only on lump sums. So then they look at the final lump sum and say, you've made a gain of this amount because of the FX, and they're going to charge it to a capital gain.
Thank you. So we've got a lot of questions to get through. I'm happy to stay and answer all of the questions. I just obviously want to advise those participants who are watching that if they want to stay as well, we'll try and address all of the questions. So thank you for posting them. We'll see if we can get through them all. Then maybe we'll try and speed up some of our answers. How are 529 education savings funds treated by HMRC? HMRC, I mean, as far as we're concerned, the HMRC, they're tax efficient exempt, and therefore they don't recognise them as taxable. I think then just looking at some of the other questions, is it best to leave your investment account in the US and claim remittance to avoid the hassle? Well, I'll answer the first part of that, Tahir, and maybe you might just want to address the payment of the remittance basis charge and how that might be impacted. I mean, the simple answer is if you are here for 1 or 2 years, then leaving your investments in the US probably makes the most sense. The hassle of moving them, there's no real benefit in bringing them into the UK if you can be organised and keep all your money overseas, as Tahir's mentioned. Unless you are bringing the money into the UK, then that remittance basis is beneficial for not having any UK arising taxes. But actually, if you're planning to stay here for any period of time, and by that I really mean sort of 3-4 years, or you think you may end up staying here, if you have a partner who is not American and may cause you to live outside the US, and or you've got kids here, etc., at school, then actually getting organised early is really the key to all of this. It doesn't mean you've got to move your money outside of the States. In fact, far from it. You can keep your money managed in the States, but have it managed in a way that acknowledges and addresses the fact that you have potentially UK tax to pay, and managed in a way that is organised from that perspective. I'll just touch actually on the remittance charge there, and that £30,000 tax is really a tax, as Tahir says, albeit claimable, but you've got to think about the amount of income that's being produced that may need to be made just to offset that amount of tax. If you have significant amounts of funds, then clearly, or you have a single year in which you are realising huge income or huge gains, then it might be sensible to do that. And this remittance basis charge is something which is an annual election, so you can opt in and opt out, and therefore it might be worth paying it on an individual basis.
Just on that point, Jonathan, it's probably worth adding that it's £30,000 a year. It jumps up to £60,000 once you've been in the UK for a longer period. And then after 15 years, there's no option to claim the remittance basis. You are considered deemed domiciled. But when you claim the remittance basis, you can't then bring the offshore money into the UK without paying an additional tax charge.
If you invest in ETFs and passive funds in the US, are you liable for taxation in the UK? Tahir, perhaps just touch on that one, please.
Of course. It depends on your residency. If you're taxable in the UK, so you've been here for a certain amount of time in the UK are taxing you on the arising basis, then yes, you will be taxable. And the tax will be your top rate of income tax in the UK. You just see these offshore funds as non-reporting, and it will tax you income tax rates. If you've been in the UK for less than 7 years, there's the opportunity to be on the remittance basis and avoid UK tax on this completely.
Thanks. Just touching back on that £30,000 charge, if I have indefinite leave to remain, does the £30,000 charge still apply? And what if I don't earn that much money? The £30,000 charge is an elective tax, so it's not something that you have to pay. It's something that you can elect to pay. The benefit of doing so, it just allows you to have that further window of opportunity to keep non-UK income and gains out of the UK tax net, And obviously, if you're a lower rate or lower income earner, then it clearly wouldn't make sense to pay that. The implications would be that the UK would have primary taxing rights on your worldwide income and gains. So just the next question, forgive me, it's quite small, I'm just trying to read it. Can you report US taxes without an extension if you report the actual taxes paid? You do not have to wait for HMRC to determine the actual amount due to your refund.
The US taxes are actually done on a cash paid basis. So it's everything that's done in the tax year. So if the refund comes, you file your taxes in January, you get your refund in February. You can still do the taxes for the previous year without any issue. It just means you need to use the foreign tax credits in the following year. And then there's opportunity to carry backwards and forwards foreign tax credits. So in the US, there is a lot of flexibility to file your return.
Thank you. How is a traditional IRA handled if a UK spouse inherits it as the sole beneficiary of a US husband? Is it treated as part of her estate in the UK or not?
So if it's inherited, there's rules on distributions that need to be made. Recently, a new act came out which says they need to be distributed by certain periods. But I believe it is considered part of her estate as a pension. Jonathan, can you confirm that?
So the US one would be, but UK pensions actually would be counted outside of your estate. Actually, maybe something just to revert back on, because I know the UK has pension rules for UK qualifying pensions that enable to fall outside of someone's inheritable estate. And obviously there are certain rules around double tax treaties for pension provisions, but I'm not sure if the IRA would not then fall within the estate because it's a non-UK pension. How can we find out which ETFs have the dual reporting status? There are a list of them online. Generally, any of the US funds, if you have US reporting funds, the UK HMRC, I believe, has a website talking about reporting fund status. You can look up those funds. In the main, I would say there's a range of Vanguard ETFs. We use those occasionally for some clients where we need some diversification in smaller pots. There's a couple of others I know that exist, like VanEck on the gold side, but there aren't that many. I think the limitations on ETFs and dual reporting ones are clearly and for US funds generally, they're generally reporting only in dollars, and clearly from a foreign currency perspective, that may not be the currency that you want to invest into. Can a US citizen hold a SIP, and is it tax-free? You absolutely can hold a SIP. And probably should hold a SIP. The SIP in itself stands for self-invested personal pension. It's just the structure. Think of it as an equivalent to an IRA from a US perspective, and it works in the same way. And as I mentioned, organising pensions, and that can be consolidating, like you might consolidate 401ks or roll them into an IRA. You might consolidate some of your pensions or workplace pensions or other pensions into a SIP. It's a question for me here. London Capital offers tax-efficient investment management for people with portfolios both in the US and UK. Do you insist on controlling all of those assets, or are you willing to provide advice on the investment? What's the minimum amount you'd manage, and how do the fees work? Probably a detailed question for that person, and happy to take it offline. But broadly speaking, obviously, from our perspective, we have a range of working with clients. We are an investment management business, so managing the assets, of course, would be our preference. But there are plenty of occasions where we're working with clients, and those clients may have certain arrangements around self-picks, or we report back on some of the other investments. It's on a case-by-case basis, but really happy to talk to that individual after this. So there was one question around how minimum amount. So our minimum investment amount is generally £1 million, and that is across different pools of capital, and our fees are charged on an assets under management basis, and typically are around about 1%. Are you familiar with the Australian tax regime as well? I'm afraid that's probably extending our knowledge base too much. I'm not sure we're not really giving tax advice here in the UK, but I know that would be something that we can't do. But certainly we will know people in our sphere who will definitely have expertise in the Australian tax side of things, and would be happy to, if you came back to us, to find somebody who could do that for you. Can US children in London hold ISAs? I apologise. I know we're sort of up for the hour, but as I said earlier, if people, we're very happy to address all these questions. There are lots of questions, all good questions, and happy to stay online unless we're going to get kicked off and the administrator can tell us that. But I'm happy to stay online and and address all of these. Can US children in London hold ISAs and savings accounts, and will they be taxed? Yes, it depends on the age, but assuming that they're under 18, there's something called a junior ISA. You can contribute up to £9,000 a year into, whereas a grown-up ISA is £20,000 a year. In fact, that's for 16-year-olds and under is the junior ISA. And 16 and above is for the £20,000. You can have savings accounts, and like the US, really, savings accounts are deemed to be taxable on the parents on an arising basis. How do you figure out if a certain ETF is acceptable in the US? And I think we've possibly claimed that, talked about that one there. Apologies. You mentioned that your firm doesn't help with tax returns. Is there a firm you would recommend? Absolutely, come back to us and we will provide some recommendations to you depending on your circumstances. Do you have experience and advice for those working in financial services who have compliance restrictions? Oh, absolutely. A lot of our clients work in financial services. Our systems obviously recognise that they either have restrictions on what they can own or can't own, and we can avoid those. We have clients who we have to get pre-compliance approval for before we make any trades. So the answer is yes. And again, if that's something that you'd like to discuss, we can do that. Can we own a PFIC within our UK SIP? Tahir, maybe you can address this one. Can we own a PFIC within our UK SIP and not get negatively impacted by US tax since it's recognised by the US-UK tax treaty?
Can you hear me okay? Sorry, I can hear a bit of feedback. There are two schools of thought on this. So some accountants say that SIPs are exempt structures, so they're treaty exempt and you can hold PFICs in them, you can hold all of these tax toxic investments. The other school of thought is that they are foreign grants or trusts and you should only hold direct stocks and bonds in them. We like to take the view that we want to be as conservative as possible, and we hold direct stocks and bonds within the SIPs that we manage. But worth speaking to your tax advisor to see what their opinion is on it.
Yeah, definitely speak to your tax advisor, see what they recommend. But generally we would be happy to look at that. Do you manage the accounts on a discretionary basis? Do you charge fees on a flat fee or time basis? Predominantly we are a discretionary only investment manager, and we charge on assets under management. We're not a firm who charges on a financial planning hourly basis. But perhaps take that again offline to look at individual situations. Investment philosophy, asset allocation to passive fund. So the question around investment philosophy, passive funds, stock picking, we're an active manager. I deliberately didn't show the chart with all some of the investments on, because otherwise we'll get into a philosophical debate around active versus passive. But I think it's very fair to say we are an active buyer's house, and I think that the last 12 months have given good credence as to why we believe in that. But happy to have a discussion around that at any time. US UK tax advisors for financial planning. Well, that's part of what we do. Obviously, on the tax advice side, it's linking up with your tax advisors, but it's thinking about that. So if there's financial planning, coordination, assets, then that's absolutely what we do. So just as a reminder, we're managing the money, but the financial planning, the coordination, the movement of assets, we've got 4 financial planners on our US team, and that's what they're there to do. That's all incorporated with the advice and the fees that we charge. Many US firms prevent employees investing in individual securities to conflict issues. hence many invest in US mutual funds. Again, probably comes back to that question around discretion, and certain firms allow us to have discretion and can do that. And if it's funds only based on who you work for, then that would obviously depend on the structure in which you're owning it. And it might be that we could use mutual funds or ETFs as a solution. What if you have historic mutual funds, US mutual funds that existed before moving to the UK? So Tahir, this is a question really about what you've owned before coming to the UK. So investments really that you owned before you came to the UK, perhaps from decades ago, is the liability the same?
Unfortunately, I always hate answering this question because the answer is yes. You're going to be taxed on the full gain. So the UK authorities will go back to the time you purchased them 20, 30 years ago and say, you're now a resident, you therefore are taxable on your full investments here in the UK. So there can be huge swings and the full amount will be UK taxable. This is why we always try to speak to people before they come to the UK, because it gives them potential to sell their assets and lift up the cost basis. But we do have planning opportunities around this. Maybe tranche down an asset, sell it over a few years to reduce the gain, look at using carry forward losses. There may also be residency planning options. So leaving the UK always seems a bit extreme, but it does depend on the size of the gain. But more than happy to speak through this question.
Question, are you related to London Capital and Finance? The answer is absolutely not. So London Capital and Finance, for those that have never heard of it, is was an organisation. It was a fraudulent organisation. Unfortunately, took London and Capital and put it into their name, possibly to try and piggyback off ourselves. I don't know. If you go to the FCA website, so the FCA, obviously the UK equivalent of the SEC, you'll find that is a defunct business that has been obviously wound up, and there's all sorts of proceedings. So definitely not us, and you'll see that we are still regulated and licensed both by the FCA and the SEC. Any tips or best practices for founders advisors on startup equity compensation of a UK company? I think this is really probably a tax question for the tax advisors, really. One to outsource for US UK tax advisors in terms of equity in a privately held business. And again, if you haven't got advisors, we'll be happy to introduce you to someone. What is the UK's asset position on overseas assets that you inherit from someone who has no ties to the US? Tahir, perhaps you could address that one.
This is the UK's position. So they would look at it from your individual situation. So the person you would inherit it from the other person, so you don't pay any tax on that. The person giving it to you, they pay the tax on their estate. But then it falls into your estate as well, and it's UK taxable. That's on the basis that you are resident and on the arising basis. If you're on a remittance basis, then there's potential that this won't fall into your estate or your ongoing UK tax position. But on this case, it really depends whether you're US resident, UK resident, how long you've been here. There's a lot of variables that change everything on that question.
Thank you, Tahir. Okay, so I'm just trying to read the next question. In the 2020, for UK pensions, the adjusted income limit rose to 240 from 150 before taper takes it. Okay, I'm not sure if that's a question or maybe a clarification point. Are US IRAs and Roth IRAs pensions taxed in the UK? Well, I guess you can address that to hear from whether they're being drawn from or not drawn from.
Exactly. So if you're taking the distribution from the pension, then it's taxable. For the traditional IRA, that is a normal pension. When you get to 75, 70 and a half, you need to take the distribution, and they'll tax it as normal income. You get a 1099R, I believe, in the US, and then on the UK side, that will just be FX'd over to pounds and fully taxed. The same with the Roth IRA as well. There's potential to do a little bit of planning around it and use foreign tax credits because the Roth is exempt, but it does depend on your tax credit situation. I think you may have missed the question, Jonathan. 42.
Well, the question there was around ETFs and whether you can check whether they are US and UK qualifying. I think I addressed that one before. So you can look at the UK HMRC has a list of all the reporting funds that are UK qualifying. As far as PFICs go, they would have to be dual qualified, but there's a very small pool of those available. Question on capital gains with the likelihood of going up. Obviously, this is going to be a specific question for each individual person. Should you do anything about it now? There's obviously discussions about in the UK and the US about capital gains going up. Clearly, with the response to COVID and the amount that has been spent, there's all sorts of speculation around the fiscal measures and how this is going to be paid for. Capital gains tax equalisation in the States was something that was widely reported by the Democrats before. In other words, so taking away the long-term gains that's beneficial preferential rates for capital gains tax and equalising them with income tax rates. In the UK, income tax is obviously much higher than capital gains at the moment, and there's speculation that capital gains may rise. My general recommendation to clients is, if you don't need the money and you are, crystallising a gain just on the basis of what may happen in the short term to capital gains tax rates, then clearly these rates move around, and I would probably say hold on if there's no reason for you want to take these now. If you've got a known liability and you want to you're going to be spending the money on something, if you're buying a house or there's something known, then it might be worth crystallising that gain now. Can you own ETFs that aren't dual reporting if you're claiming remittance? Tahir?
Yes, you can. If you're claiming the remittance basis, you're only taxable on your UK sourced income and anything brought into the UK. So it would have to be an offshore ETF. So it would have to be a US mutual fund, because the remittance basis is strictly a UK concept. I'm assuming this person's a US citizen. So if you hold UK ETFs, they're going to be caught by the PFIC legislation. So you need to hold US mutual funds. Then they wouldn't be tax disadvantaged by the UK.
Thank you. Does the UK tax on inheritance in the US? I think that's a similar question to the one we've had before. Again, I suppose it's you're not taxed on receiving the money from the inheritance. I think is the short answer to that. But as Tahir mentioned, then those assets would fall into your UK estate, and that would then require some form of estate planning from a UK perspective. What brokerage firms do you trade through and what custodians do you use? A very specific question, probably one for us to pick up with. We are effectively the brokerage firm. We are the investment management business. I didn't go into too much depth, but we've got about 110 people in our organisation managing the assets. About 30 of those are investment professionals, either working in central functions on our investment desk, asset allocation and security selection, or working in the portfolio management teams, looking after individual client portfolios. There is a question about the split of gender in our organisation. I'd like to answer that specifically, and I don't know the exact number. I could probably get it whilst next time Tahir is talking through. I'll see if I can find the answer to that question if Tahir's answering one of the next questions, but I don't want to give you the wrong answer. Most UK employer pensions invest into funds. Preferably, they might be taxable in the US, then for US citizens. I'm not sure. I'm not sure that most pensions funds are UK employer pensions taxable for US citizens if they invest into funds. Maybe you can address that question, please.
This comes back to the same issue as before, whether it's considered a foreign trust or not. But fortunately, UK employer pensions are qualifying under the treaty. There's clear provisions that they qualify under the US-UK tax treaty, and they are tax exempt, which means any of the investments in there will not be taxable to the US, and you can invest in funds.
Thank you. Didn't allow me enough time to find the answer to the other question, but SEC licenses, yes, we are SEC licensed, and you'll see our registration with the SEC. So we're fully licensed to do business in all states across the US. So that means we can not only look after US citizens who live in the UK, but we can look after US assets based in the US and also US resident clients. So a number of our clients will be either Americans living there, connected parties, or people who've lived here and then moved back, or Brits who've moved to the States. And we can manage all sorts of structures. The only structure I should say that we can't manage, we can do trusts and pension assets. We can't manage 529 plans. What taxation applies to a gift to a US child from one US and one UK parent? Does the child pay taxes in the US and the UK? So I guess that's just addressing gift tax. So briefly, if you could just touch on that, Tahir, thank you.
Of course. So the gift from the one US parent, that would come out of the, there's actually an allowance on a yearly basis to make gifts to children. But let's assume all these allowances gone through, it would go through their lifetime allowance. There's no US tax implications. And then from the UK parent, the gift would be a potentially exempt transfer. As long as the UK parent survives for 7 years, there are no UK tax implications. When the funds are with the child, I'm assuming this is an investment, then depending on their age, they may be liable to their own tax. I'll assume for now that the child's a minor child. If they are a US child, they will need to go on the US parent's tax return and file probably as head of household. And then same with the UK, there's limits on the amount you can do, and it's a self-assessment basis. But depending on the level of income, the child may need to file their own UK tax return as well.
Okay, that's. I think we've answered all the questions. I didn't get around to finding the answer on the gender split. Very happy if that person can look me up and send me an email. I will absolutely respond to that question for you directly when I've got the exact number. I was just trying to find a proposal that we probably put that in recently to address that. Thank you for those who stayed. I apologise to those who that we've run over time, but I hope it was helpful. And I apologise to Michelle for overrunning and you staying as well. But thank you very much indeed. Thanks once again to the Penn Club and the Wharton Club of the UK. And thank you specifically to Michelle and Ashley for asking us to do this.
And then thank you, Jonathan, and Tahir from both of the Penn Club and the Wharton Club. Clearly, with almost 80 attendees and over 50 questions, it's a topic that's of great interest to both clubs and highly interactive. So thank you also to all of our attendees. We do have a full slate of events coming up, including a Shakespeare Book Club event this month in February, a panel on venture capital debt, and an event on entrepreneurship in artificial intelligence. So lots on the calendar. So keep an eye out for both of our clubs' newsletters on your emails. And thank you again to Jonathan and Tahir, and everyone have a great evening.
Thanks, Michelle.